Hello, everyone, and welcome back to Nonprofit Auditor Points. And I'm Irina Ryshkova, your nonprofit auditor. In our last episode, we discussed fixed assets depreciation. What depreciation means under GAAP, how it is calculated, how depreciation affects nonprofit financial statements. Today, we're moving into another very important practical area of fixed assets, maintaining accurate fixed assets records and properly account for fixed assets disposals. Because in practice, fixed assets accounting, it's not only about purchasing price, recording the assets and depreciating it. Every asset has its ending life. And it means that organization need to record properly asset when its useful life is over, when the asset is disposed, when the asset no longer exists or cannot be located, and properly remove it when the asset is no longer in use. And from audit perspective, this is another area where organization encounter a lot of problems. I assume the problems exist because it does not happen very often when the organization retire or dispose or sell fixed assets. These activities are seldom, and therefore nonprofit encounter them once in a while and not always treating them correctly. Sometimes organizations still have assets listed on their depreciation schedule that physically disappeared years ago. Other times, organization disposed of the asset, but never inform accounting department that the asset is gone. So it's continues sitting in a books. And sometimes organization continue depreciating asset that no longer exists at all. So today we're going to discuss purpose of fixed asset schedule, physical inventory and verification process of existing fixed assets, investigating discrepancies for fixed assets, accounting for disposals, and several other internal control considerations for fixed assets. Let's start with the fixed asset schedule itself. The fixed asset schedule is essentially the detailed supporting records for the organization fixed assets, all of them. And the general ledger may show only broad balances of the fixed assets, like total for equipment, total of furniture, total of vehicle, or total of building. But the fixed asset schedule provides detailed breakdown and support for those totals. So relying simply on your general ledger to maintain your fixed asset will not be sufficient. And the schedule is extremely important because the schedule itself provides support of depreciation calculation, financial statement disclosures, insurance records, internal controls, and overall organization stewardship over the asset. A good asset schedule usually includes more information just simply general ledger. It has description of the asset, and as we remember, general ledger has payment of the assets, not the necessarily description of the asset, just payment of the invoices. So description of the total asset category, land, building, leasehold improvement, etc. Acquisition date when the asset was placed in service, meaning start depreciation date, historical cost, useful life, depreciation method, we discussed it's a straight line, accumulated depreciation as of specific year end, and net book value as of the specific year end. Many organizations may include additional information that helps them to track the asset for their internal policies and procedures, for the internal control. And they may include asset tag number, serial number, like for the computers, for the laptops, physical location, if there is more than one location exists, department, responsible employees, vendor information, and disposal status. And one very important point, fully depreciated assets that are still in use generally remain in a fixed asset schedule until they actually disposed of. Even if we have a fixed asset, so let's just say it was vehicle and cost of vehicle was $60,000 and useful life was 5 years, and after 5 years cost equals accumulated depreciation. On the balance sheet we will see cost $60,000, accumulated depreciation negative $60,000, so net book value would be 0. However, if the asset vehicle still in use by organization, they still driving it, the asset should not be removed from general ledger or from the schedule because it's still in use. We're not going to record any depreciation expense, no accounting transaction, and we will not dispose fixed assets vehicle until it's actually in use. Once it has been disposed, sold, whatever, then we will do some recording in accounting system. In some cases, it creates confusion because when organizations see that the net book value is 0, some nonprofits assume it needs to be removed. No, there could be fully depreciated assets that are continues to be in use by the organization and they still need to be recorded on the books. Now, let's move into physical inventory and verification process. A fixed asset schedule, it's not only useful if it is reasonably matches, it's only useful if it's reasonable matches the reality. It actually has to match real life. If nonprofit has 10 computers in real life, the schedule also have to have 10 computers. The purpose is straightforward, to confirm that recorded assets actually exists and they remain in service and located where the organization expects them to be. So this becomes especially important for cameras, vehicles, laptops, computers, any other portable, high-risk, expensive fixed assets. Many organizations use asset tags to identify numbers attached to equipment, so it's much easier to do physical inventory observation. During the physical inventory procedures, organizations compare physical assets to fixed asset schedule just to confirm the assets still in place. And this process often reveals some discrepancies. Sometimes asset cannot be located. Sometimes equipment was moved from one location to another location and records were never updated. Sometimes assets were disposed years before but remain on the schedule. Occasionally, organizations discover assets that they were never added to fixed asset schedule at all. That happens especially when the asset was donated to a nonprofit. And not every missing asset, meaning automatically it was a theft or fraud. There could be some other explanations, and as I mentioned before, the asset might have been transferred or put in storage. During the COVID, a lot of nonprofits put their furniture in the storage or discarded or replaced or relocated. But the organization should still investigate if there's any significant discrepancies, document the results, and they need to make sure that at least once a year, annually, fixed assets matches general ledger and the records agree and all assets that are on a schedule physically exists. An organization needs to indicate what assets were disposed, transferred, donated, if there's any assets needs to be write off, etc. So it needs to be documented in the records what happened to the asset if it's no longer exists. Now, let's move into disposal itself. Under GAAP, when the fixed asset is disposed of, the organization typically removes both cost of the fixed assets and related accumulated depreciation. Because as you remember, we're talking about the vehicle, $60,000 cost, and its accumulated depreciation at the end of the useful life, it will be also $60,000 contra asset account. So when the asset is disposed, both needs to be removed, cost and accumulated depreciation. If the cost and accumulated depreciation at the time when the asset was disposed equals, meaning the asset was fully depreciated, there's going to be no gain or loss. You just simply debit accumulated depreciation and credit related fixed assets for the same amount, $60,000. No gain or loss. But let's start with a simple example when the asset is actually sold for money. Suppose nonprofit sell an old vehicle. And so in order to record the sale of vehicle, we need to remove original cost, remove accumulated depreciation, and then in separate transaction, we will need to record cash that we received from the buyer. And if in our previous example, cost of the asset equals to accumulated depreciation, $60,000, but the asset was sold, let's just say for $5,000 to buyer, the following entries will need to be recorded. Debit accumulated depreciation for $60,000, credit cost of the asset for $60,000. This is entry number 1 to remove fixed assets from the books. Now we have to record sale of the vehicle for $5,000. It will be debit cash for $5,000 and credit revenue. That would be gain from the sale of the vehicle, $5,000. So 2 transactions. This is the gain from the sale of the fully depreciated vehicle. If the process of the sale is the less than the net book value of the vehicle, the organization needs to record a loss. For example, if accumulated depreciation was only $50,000, cost $60,000, and the asset was sold for $1,000. Again, $60,000 cost, accumulated 50, so net 10 left, but it was sold only for $1,000. So to remove that asset, we need to debit accumulated depreciation for 50, credit asset for 60. That's we're removing cost and accumulated. Then we debit cash for $1,000 and we record loss on disposition of the asset, $9,000. So depending what is the net book value of the asset and what happened to the asset, we will record either gain or loss or nothing. Organization occasionally records sale proceeds incorrectly by simply reducing the asset account directly without properly removing accumulated depreciation or calculating gain or loss. And sometimes organization disposed of the asset without receiving any proceeds. For example, when asset is broken or it's obsolete or damaged or just lost. In this case, we simply remove the cost, accumulated depreciation, and if there is a difference between cost and accumulated depreciation, the amount will be loss from the disposition of the fixed assets. So every time when you're disposing fully depreciated fixed asset, meaning when the cost equal to accumulated depreciation, you will never gonna have gain or loss because it's a fully depreciated. But if you disposing the asset not through sale, but and it's not fully depreciated, the difference between cost and accumulated depreciation will be loss. For example, vehicle $60,000, accumulated depreciation $50,000, the asset was disposed. So we will debit accumulated for 50, credit vehicle for 60, and we'll record loss for 10. Right. So another interesting situation exists when when asset is donated. Sometimes nonprofit donate equipment, furniture, or vehicle to another nonprofit organization. In that case, organizations still need to remove the asset because that asset is no longer the organization fixed asset. So the organization needs to record removal of the asset by crediting it, removal of related accumulated depreciation by debiting it, and then separately record donation. Now, let's talk about financial statement presentation. Gain and losses related to disposal of the fixed assets generally appear in the statement of activity as changing in the net assets without the donor restrictions, unless it was any restrictions attached to the fixed assets, which does not happen very often. And also when the disposition happens, good records need to indicate date, and when it was disposed, and if there's any restriction on the use of the fixed assets. Without an accurate schedule and disposal procedures, disclosure may be non-reliable. In my practice, the nonprofit organizations that have material fixed assets, either a lot of fixed assets or just very material number, maintenance and recording of disposal fixed assets are very critical because they can create really distorted financial records if not recorded correctly. Let's finish with few important internal control considerations. Good fixed assets procedures usually include written authorization for disposal. It should not come from one person. There has to be inventory observation list. During that inventory, assets that not longer exist needs to be identified and it needs to be authorized, communicated to the accounting, and accounting department should be properly recording the disposal of the fixed assets. That communication to accounting department should be timely. The ideally should be a week of the year when the organization scheduled observation of fixed assets. During that week, every department should be aware that its fixed assets accounted, updated, and properly recorded. There has to be some segregation of duties, meaning the people that do physical inventory observation of fixed assets should be different from the people who records them, approve disposals, and records them in accounting records. And that process needs to be done at least annually. It can be done more often, but at least annually, physical inventory observation needs to be done. Organizations should periodically compare physical inventory results, their insurance schedule, capital purchases, and fixed asset schedule to make sure that all of them agree and none of the records are outdated or do not agree with each other. So before we finish today's episode, let's summarize the key ideas. Fixed assets accounting does not end after the fixed assets was purchased and put in operation and we start depreciating it. No. Organization also need have an accurate fixed asset schedule to make sure that the schedule agrees to general ledger, do periodic inventory procedures, record disposal on the fixed assets, and that process needs to be repetitive at least once a year. Assets needs to be properly recorded through sale, scrap, disposal, theft, donation, or just simply abandonment. Every time it take place, this information needs to be communicated to accounting department, and the accounting department needs to remove these assets from the books and record gain or losses. That's it for today's episode. Next time, we're gonna talk about another important area. It's construction in progress, and when we place in service construction in progress, when the construction or CIP becomes actual fixed assets, depreciable fixed assets. We will discuss assets under construction, projects that has not been yet operational, when depreciation actually starts, and the most common accounting mistakes related to placed in service timing. Thank you so much for being here today with me. Hopefully that was useful. Thank you, and see you next time.